The stock market rally continues. Hello, thank you for joining us for our quarterly market review and outlook. My name is Jason Gunkel, and I lead our investment team here at Severson Strege. It's been another strong quarter for the stock market so far as the recovery from the recession caused by the pandemic continues. We're recording this about a week before the end of the third quarter, and so far the market has, as represented by the S&P 500 index, is up about 4% for the quarter and 20% year to date. Meanwhile, the bond market has held up this quarter as interest rates have continued to stabilize. The Bloomberg Barclays U.S. Aggregate Bond Index is up about 1% for this quarter and only down about 0.6% year to date. The S&P 500 has now gone over 200 days without at least a 5% drop. I should mention today the market experienced a rather large drop of almost 2% after some fears of a Chinese property company that may be on the brink of default. However, the biggest drop so far year to date from peak to trough has only been minus 4.2%. And in only 3 other calendar years has a drawdown been less than that. In 1964, 1995, and 2017, according to information from Schwab. So what is driving the stock market further up? Perhaps the biggest reason is strong company earnings. For the second quarter, 87% of S&P 500 companies reported earnings and revenue that beat expectations, which was the highest percentage since FactSet began tracking this metric in 2008. For the third quarter, the estimated earnings growth rate for the S&P 500 is nearly 28%. If that is the actual growth rate for the quarter, it will mark the third highest year-over-year earnings growth reported by the index since 2010. From the graph shown here, you can see that earnings growth and stock prices typically move in close step with one another. Another key driver of stock prices has been the steady rise of employment since the pandemic. Employers added 943,000 jobs in July, which was the best gain in the previous 11 months, and the unemployment rate fell from 5.9 to 5.4%. Another 235,000 jobs were added in August, which pushed the unemployment rate down to 5.2%, as reported by the Wall Street Journal. The biggest risk to the economy and market is probably rising inflation. The 12-month inflation rate rose to 5.3% in August, according to the Bureau of Labor Statistics, which is well above the Federal Reserve's 2% long-term target. This chart shows the top 20 increases in prices for goods and services from 1 year ago, which includes a 45% increase in the price of used cars and a 17% increase in moving and storage expenses, to name a couple. The disruptions in the supply chain due to the pandemic, such as worker shortages, production facility closings, and shipping congestion, are likely the primary reasons for the surge in prices. In fact, shipping log jams are back to the worst levels of the pandemic. One way this can be seen is to look at the rise in the number of container ships waiting to be unloaded in San Pedro Bay outside of the U.S.'s busiest ports of Los Angeles and Long Beach. July and August had a steady rise in congestion back to the peak of February. The next few weeks may continue the flurry of activity for companies to book containers for transit to have products available in time for the holidays. Another primary driver of inflation that could have a more lasting impact is rising wages. Average hourly earnings rose 3.6% in June compared to a year ago. That's the biggest spike since January of 2009, according to data compiled by the Economic Policy Institute. As particular industries such as manufacturing, food service, and transportation are desperate for workers, employers are being forced to increase wages. Higher wages tend to be sticky because it is harder to lower someone's wages after they have received an increase. Eventually, companies will likely pass these higher wages on to the consumer by raising the prices of goods and services. You can hear more of our thoughts on inflation in an upcoming event on November 16th, so be on the lookout for more details on that. The U.S. shifted fully into the mid-cycle phase of the economic recovery, where growth rates near their peak, according to information from Fidelity. As you can see in the chart, the U.S. is ahead of most countries on its growth trajectory, with the exception of China. The U.S. economy should continue to grow into the foreseeable future, but the growth rate will likely start to decline. So what does all this mean for your portfolio? The chart shows how various sectors of the stock market tend to perform during different phases of the economic cycle. The more value-oriented sectors, such as financials and real estate, tend to do better during the early stages of an economic recovery. We tilted more towards value stocks in the beginning of the year, and those sectors have done well year to date. As the economy enters the mid-cycle phase of the recovery, some more growth-oriented sectors such as technology start to outperform. So predictably, during the third quarter, we saw growth sectors start to catch up with value sectors. As economic growth starts to decline, more defensive sectors such as consumer staples and healthcare start to outperform. However, we think it is still too early to tilt towards these defensive sectors. As the performance of the various parts of the market are continuously changing, our investment team will continue to evaluate which areas we believe look most appealing. While the stock market appears expensive by most measures, and inflation poses risks for investors, we remain optimistic. Unemployment is low, consumer demand remains high, and company profits continue to be near record high levels. As the economy continues to expand, even though at a slower rate, we would expect the stock market rally to continue as well, but likely with some more volatility. Thank you for joining us for this quarter's market review and outlook. Enjoy the fall weather and football season, and we will see you next quarter for the final update of 2021.